Good afternoon, everyone. My apologies for a little bit of a late start. But hello to everybody, and thank you to today's Currency Hedging 101 webinar, Managing Currency in Volatile Markets. Look, fantastic to have a very diverse audience join us today. Frankly, the team here at OFX have been overwhelmed by the response, and we're very appreciative for everyone joining us today. Look, before we do jump into it, again, we've got a relatively jam-packed agenda, so again, apologies for the late start. But in terms of housekeeping, a couple of acknowledgements, I suppose. Firstly, our recording will be sent to all attendees, along with the slides post this session. We'd recommend everyone joining us today does keep a record in order to claim your CPD points as part of your 20 hours of ongoing learning. Look, certainly one of our motivations today is to ensure that the next hour or so is as interactive as possible. So we will ask that everybody does hit pause just briefly on any questions. We'll certainly do our best to answer those towards the second half of the hour. But with that said, a small widget should hopefully be appearing on everybody's screen shortly, which will provide a channel for everybody to lodge some questions as well. Throughout the next hour, also a little bit of a call out that we will be answering, I should be asking the audience today quite a few questions, or a few polls if you like, throughout this session. So again, we'd love to hear everybody's responses throughout. And just finally, look, we will ask everybody to participate and complete a survey at the completion of the session. Obviously, all feedback is, again, greatly appreciated. Look, firstly, by introduction, look, my name is Michael Judge. I am the head of Australia and New Zealand here at OFX. Delighted not only to be joined by everybody on the call today, but equally delighted to be joined by someone I've worked very closely with over the last decade. He goes by the name of Jonathan Sermon. And again, Jonathan is one of our senior partnership managers here at OFX. Jonathan has some rich and deep experience across the FX and financial markets more broadly, having worked in the industry for near on 20 years. Before we do jump into the agenda, look, very conscious we've got a vast and very diverse audience today. There are many businesses who are on the call today, equally a lot of private clients. We do as well have many existing and potential partners joining us, which basically does mean people who are advising or in looking to broker a better deal for their end customers as well. So we're going to make every effort to ensure that they OFX is a business which Sydney's Northern Beaches. OFX was, I suppose, founded on the belief that there had to be a better, fairer way to move funds around the world. OFX is now proudly a global business. We do provide services to more than 1 million customers globally. Today, we are essentially driven by that same mission, to provide our customers with the best of both worlds. That is a seamless digital platform which is supported by real people who are available 24 hours a day, 7 days a week. So we are a specialist provider of FX services. And again, we do have global provisions from a licensing, banking and regulatory standpoint as well. In terms of a specific agenda, again, what we're really keen to ground ourselves on as a starting point is a little bit of an assessment or a little bit of an observation, I suppose, in terms of the things that OFX is seeing today in the global currency markets of today. Obviously, currency markets and financial markets more broadly is something that we're very passionate about and something that we are immersed in every single day. And the context and the importance of understanding the markets of today will become more relevant and a little bit more meaningful towards the second half of today's webinar. And that is, I suppose, where the conversation will naturally pivot to one around currency risk management and ultimately how businesses and customers could look to obviously shape a currency plan to either maximise currency outcomes or in fact defend against certain currency objectives as well. But I think to crystallise our intent today, I think fundamentally and most importantly, we really are hoping to give everybody a little bit of a toolkit of knowledge, I suppose, in terms of how they could go about building a currency plan and some of the considerations which a lot of people should start to think about in terms of mitigating or, where possible, eliminating FX risk. So let's jump into it. Look, as I mentioned earlier, today's session, where we can in a virtual sense, love to be as interactive as possible. Our first poll for today, a question for everyone to quickly ponder, and it will take, I suggest, probably 30 seconds just for responses to come back in. But a quick question that if everyone could quickly, I suppose, respond to. What does everybody today think is the biggest driver of Australian dollar volatility? All right, so we're just collecting responses. We'll give it about 30 more seconds. Okay. All right, interesting enough, I mean, we did provide 4 or 5, or 5 specifically, different alternatives there in terms of the key influences of markets of today. You know, interestingly enough, it was a relatively even split, with 37% of today's audience nominating the US political landscape as being the #1 contributor to volatility. A close second, 35% of the audience did nominate interest rates and government stimulus as playing a very big role. And again, it's very hard to dispute, I suppose, those two different perspectives. But I think one of the reasons I love that question today does, I suppose, naturally overlay to some of the key things we are seeing, you know, which is today, something which is unique about the environment is I suppose, a starting recognition to say that there are 4 or 5 different influences which are actually having a big impact, not only on global currency markets, but in particular for a lot of the Australians today, that is the Australian dollar in particular. If we were to cast our eye back and have more of a historical lens over the AUD or currency markets, typically what we will observe is a broader obsession by market participants, an obsession by a lot of investors around 1 or 2 key influences. Whether it's the GFC or the sovereign debt crisis of Europe, or in fact, you know, Brexit's of which are still ongoing. I think what's unique about what we're observing today is this reality, I suppose, that there are in fact 4 or 5 big drivers of volatility. And that word volatility, I think, is something which in the past has probably been overused. But today, I think it is absolutely right and absolutely fit for purpose in the dynamic markets we are observing today. So I think if we ground ourselves against what we are observing, again, we take a short history lesson, not in too broad a spectrum, but in terms of what we've observed over 2020. The reality is the Australian dollar has ranged by a dramatic 35%. Now that's the type of volatility or the type of currency range that you would typically expect over a much broader time frame. Typically, you'd expect a currency range to be a lot tighter. And again, 35% over 6 months, something you'd typically observe over a period of 2 to 3 years. And one of the main reasons for that, again, speaks directly to the fact that we have seen, again, an initial COVID response and equally a secondary phase response, which speaks directly to levels of optimism around a potential vaccination. We've seen a US election and then a campaign lead up and a subsequent result. We've seen record levels of government stimulus, and we've seen record levels of monetary settings from the global banks all around the world. And again, we have also seen heightened levels of geopolitical unrest and uncertainty as well, both in the form of US-China trade debate, but more recently as well, escalating relationships or tensions between Australia and China as well. So again, as we enter the final month of 2020, global markets have had to absorb not one, but in fact close to 5 big impact styles of events or styles of themes. And as a result, I think that speaks directly to the volatility that we've absorbed, but equally the volatility that we are expected to see ongoing as well. So again, typically what this means for the Australian dollar is, I think it's a question that we get asked, frankly, every single day when we interact both with our private clients, our partners, and a lot of businesses as well. The reality is where the AUD sits today is it does sit at a level which we haven't seen, frankly, for a period of 12 months. We are now touching highs of 74 or 74.5, levels which actually exceed pre-COVID exchange rate levels. And a lot of that positivity speaks to market sentiment, which has frankly been supported by a positive US election result, as well as ongoing optimism that there will be a vaccination available off the back of the COVID-19 virus. So those two impacts have actually supported the currency in the near term, all the way to the point where the currency is now sitting at a level not seen in 12 months. And as a result, again, we're calling it to be a period of not just heightened volatility, but I think for the AUD in particular, it is really now at an inflection point where if it is to continue higher, again, we're going to be navigating waters which are a little bit unforeseen. And that's basically on two fronts. The markets of today are unprecedented in that the trigger of initial volatility has been the COVID pandemic. And secondly, as well, the monetary base and the level of fiscal support that we're seeing today and expected to see into the future as well is also unprecedented. So the level of support, the level of liquidity has never essentially been at the levels that we're observing today. We are expected heightened levels of volatility to remain. And we are seeing the two key drivers to positive tied to thoughts around a COVID vaccination and equally the ongoing support of global banks as well. As I mentioned earlier, grounding yourself in the markets of today will become increasingly more contextualized over the course of the next hour. If you are a business or a consumer who are looking to navigate heightened levels of volatility, to understand some of those key influences is actually very important. And a heightened level of awareness around markets of today can actually create real value or actually provide a real pillar of strength if you're looking to navigate volatile periods into the future as well. So as I mentioned earlier, one of our key motivations today is to, I suppose, craft a little bit of a framework around businesses or consumers who are looking to create a very basic or easy to implement currency plan. And the starting point for businesses or consumers who are looking to create a currency plan starts with a general understanding of risk. So to start with, frankly, what is FX risk? And secondly, again, we're going to talk a little bit more deeply around what is your risk profile and equally some of the general types or most common types of risks that we will typically help a lot of customers navigate as well. So look, just to first step, what is FX risk? FX risk refers to the losses that an international transaction or transfer may incur due to fluctuations in the value of two different currencies. So what this graph illustrates in very simple terms, if you were to be buying a small parcel of currency, in this example, 20,000 US dollars, if you were to have made that transaction on the 6th of January versus making that transaction only 4 months later on the 7th of April, the cost of inactivity or the cost of transacting on the 7th of April versus the 6th of January, again, a relatively small parcel of currency over a very small period of time, again, that could actually result in a realised additional cost of close to 3,400 AUD. So in this circumstance, the actual realised FX risk, in a monetary sense, can be tabled at 3,400 Aussie. All right, that brings us to our second poll. And again, it is, I suppose, premise this question in recognition that there has been a lot of businesses, in particular in Australia, which have suffered, unfortunately, unprecedented levels of FX risk over the course of the last 6 months. So the question that we're going to ask the audience today is, on average, how much do you think Aussie importers and exporters reported in FX losses through Q1 2019 and Q1 2020? So again, a 6-month period between, let's say, October 19 all the way through to March 2020. And again, we'll just hit pause for about 15 seconds whilst results come in. Okay, so again, a relatively close mix, but again, there's probably an acknowledgement here. Again, 41% of the audience has estimated that those losses through the period were around 100,000 Aussie. What some of the research findings alongside one of our research partners, Eastern Partners, has actually identified that a staggering 8 out of 10 Australian enterprises did in fact suffer currency losses through that period. Again, Q4 19 through to Q1 2020. Again, this research was according to Eastern Partners' Global Business FX Analysis. And what it did show is through that period, importers and exporters did report FX losses to the value of 28,200 Australian dollars on average. And again, averages can be a little bit deceiving, but what it did show is a broad range of losses, which span between 1,000 Aussie all the way in excess of 100,000 Aussie dollars. And what this graph basically does illustrate is what these losses did kind of look like through different sizes and different types of businesses as well. So again, it shouldn't come as any surprise to say that as you move into larger businesses, and frankly, often more complex business models as well, you'll typically start to see higher levels of FX losses being recorded. But I think equally, what we would typically like to educate our customers on is a recognition that in fact, very small organisations or in fact private clients which might have very small underlying FX needs can still benefit from a very basic currency plan. And it's often at the lowest scale that there are enhanced observations around vulnerability or sensitivity to currency exchange rates. So what we started with is a basic premise around what is FX risk. And I think, again, where we would typically have very active conversations with customers is around helping them realise where they should in fact sit on a barometer of, I suppose, a risk profile. So again, whether you're an individual or a business, it's really important to assess what your underlying and very unique appetite for risk is. And again, what this graph shows like is, it's a very basic question simply to ask, are you by your own definition someone who has a high tolerance for risk? Or conversely, are you incredibly risk adverse? Now, again, there's quite a few questions or quite a few variables which we can actually help talk you through to help you self-realise or self-analyse where you should actually sit on this barometer. So I think, if you are by definition someone who's quite risk adverse, if you are by an example, a business which operates in a highly competitive environment, if you are one of many competitors, If you do operate as well on very slim operating margins, if you go through periods, for example, of varying degrees of profitability, again, all of these types of assessments should naturally mean you should be lobbing yourself, frankly, on the risk adverse end of the spectrum, regardless of what your underlying appetite, in a natural sense, is kind of telling you. So again, if you partner with an FX expert or a specialist provider, they can actually help build out an assessment over where you should frankly be sitting on this risk barometer versus where you probably are sitting today. So again, in terms of a basic checklist, I should say, for a number of clients and some of the things they should start to consider. Again, we've used the word risk quite regularly already, but again, it's really important that businesses and clients as well, they do start to understand some basic types of risks that they do face in addition to their underlying risk profile. So again, starting at a basic sense, one of the most common types of risks we often see businesses, by example, face is a transaction-based risk. The example I'll offer today is in an importing orientation, where an importer may well be facing an invoice which is due in 90 days' time. The cost of an invoice might be $50,000 US. And in this example, the risk in fact surfaces on day one, but they don't actually need to make an underlying payment until day 90. So again, there are, I suppose, some limited variables in play here. The first of which is they have a defined amount of currency exposure, that is 50,000 US dollars. They do have as well a relatively defined period of time to manage that risk, which is in this example, again, 90 days. One of the common misconceptions or mistakes we too often observe in this type of circumstance is that businesses will be very reactionary or almost forced into a mindset they need to cover that exposure in one tranche, either on day one or frankly, ride that wave of volatility, absorb a high tolerance of risk through the whole period and execute against that full parcel of 50,000 US dollars on day 90. But again, the reality is they should be using the full spectrum of that period to their advantage. And again, they can start to look at multiple product options to help smooth out some of the currency fluctuations in that period. And by doing so, I suppose, ultimately avoid some of the nasty edges which might surface from an exchange rate perspective in that specific period. I think it's really clear for me to point out at this point when we talk actively now around FX risk management, that one of the ultimate objectives is around achieving a satisfactory or above average FX or exchange rate outcome over a set period of time. Common misconceptions are often premised against beating the market or achieving a maximized or optimal outcome. But again, the reality is, in the example that I've just put forward, you may well expect to see an exchange rate fluctuation between, say, 72 US cents and 76 US cents. And what we are really looking to achieve is above average outcome and a satisfactory outcome, which does, again, eliminate some of those worst case examples which may well materialize. So now what we're going to do around, again, types of risk, and frankly, again, there are a lot of different types of risks, and I appreciate I've only put forward one very basic example around transaction-based risks. But again, risks do differ in terms of size and equally complexity. You can certainly imagine if you are a business who are operating around multiple markets, around multiple currency corridors as well, if you are, by example, forced to repatriate multiple currencies across multiple, around multiple markets as well, again, you can imagine the complexity and I suppose the level of activity that you're going to put around your currency plan needs to reflect that as well. But again, we'll park that for the time being. So again, what we will do is, we're kind of moving now into, I suppose, the heart or the core of a currency plan. And again, this kind of speaks to objective setting. So again, we're now at a point where you've established a basic understanding of risk. You've probably determined where you should be sitting on that risk barometer that we previously illustrated. And again, we're kind of getting into the heart of your considerations, which is to say, what are your objectives going to look like? And again, your objectives should frankly set the course for what success looks like, both now and in a future sense as well. And again, when we say what does success look like, when we're talking about risk mitigation, you should always use your objectives as the barometer of success, again, versus looking purely at the markets of today or the markets of the future as well. So what I'm going to do briefly now is, I suppose, talk about some very basic objectives, and again, some objectives that we see, frankly, play out in a very live environment every single day. One common objective, which again, a lot of businesses, and this is equally applicable for a lot of private clients. If, for example, you're a private client who may well be looking to make a house purchase in the UK, you may well have a house price determined in Great British pounds. And again, the cost of that house is ultimately going to be determined in this example in Australian dollars. You may well seek to set a target, budget, or even a break-even rate. So again, in a basic accounting sense, you may well look to assign in your own assumptions what good looks like, or I suppose essentially something which is plausible or digestible from your side from an exchange rate outcome. Now, again, you may well consider your appetite for risk, your understanding of risk in the markets of today when setting that target rate or that break-even rate. But again, when you work with a currency specialist, what we can do is obviously start to match up either a product or a mix of products to help you achieve that target exchange rate or that break-even exchange rate as well. So I suppose if you are a business who are operating in the Aussie-US corridor over the next 12 months, you may well be looking at the markets today and you might well be craving some certainty. And what you may well be looking to do to create that certainty in your cost base, which will ultimately allow you to create certainty in how you set prices to your customers. What you may well be looking to do is establish a targeted exchange rate through the course of the next 12 months. And again, we'll get to it shortly. You can obviously look to use a mix of products or certain particular products, either to protect that target rate, or depending where you set it, if you've set it quite aggressively or quite optimistically, again, there are a different set of, I suppose, products which can help achieve that type of an outcome as well. I think what we also, again, tend to observe around objective setting, and again, it can actually be quite nicely aligned to that target rate approach, which I've just touched on, is an objective which speaks to defining a hedge ratio, or if you like, a fixed level of participation. So in this example, again, what we'll put forward is a 60-40 hedge ratio example. And what that means is that a business or equally a private client may well make an active decision to actively, I suppose, protect or hedge 60% of their known FX exposure. And what that will do is create certainty over 60% of your known identifiable risk, whilst in the same token allow participation and again added risk for the remaining 40% of your known exposure. So again, typically what we will observe is that hedge ratios will often reflect the dynamics of the markets today. So again, typically during, I suppose, environments for an Australian importer, so again, US dollar cost base, which is denominated in Australian dollars, you will typically see hedge ratios increase during an environment where the Australian dollar is falling, because again, there's an added sense of fear, and often there is an added sense to be more conservative, and again, a lot more defensive in how you set these hedge ratios. But again, you can well imagine that a combination of a target rate and the use of a hedge ratio is something which might be quite appealing. So again, you might set up a target rate for 60% of your requirement, and you will again actively participate against the other 40% of your known exposure. So two very basic examples, or objectives if you like, which can be used, which are actively used. But again, partnering with an FX specialist can help you actually craft some of these objectives which are actually fit for purpose and right for your business or underlying transactional needs. Okay, so the third poll for today. If we were to ask everyone's audience today, and again, for those of you who are actively participating in FX market, which statement best reflects your current usage of FX risk products? Okay, so again, some relatively insightful responses. Look, more than 70% of our audience today has at some particular point in time obviously had a requirement or in fact used FX risk products, with I suppose a smaller portion of today's audience having actively used hedging or FX products in the past. So again, typically our observations, particularly around our portfolio of customers, is that there is too often an acknowledgement that the value of an active approach to risk management or the use of specific hedging products, frankly, is actually underutilized. The reality is, in today's environment, there is a whole heap of availability in terms of resources, in terms of platform, and in terms of product as well. But too often, particularly in a business setting, considerations around FX risk management are often viewed as secondary. And again, we will typically observe heightened levels of demand when we observe heightened levels of volatility. And what that does tell us is that there is a generally reactive or responsive approach to hedge. The final part that I think is quite core to building out an active currency plan. So again, I've kind of touched on very briefly around the different types of products or the mix of products which are available. But again, the products which are available to OFX customers, again, we've kind of displayed some of them here for you. And again, I will go deeper on a couple of them in particular. Look, just firstly, for customers that do have a transactional based need, we do have a platform, we do have readily available support and equally bank beating exchange rates for customers who are simply looking to make payments from A to B or from B to A. And that is, you're looking to book a payment today at today's exchange rate with a nice seamless experience to underride that. For private clients and businesses as well who are active, who are looking to, I suppose, simply start the journey or start, I suppose, their interest in hedging products. The first one we'll typically talk about is forward exchange contracts. Now, again, highly accessible, and again, once you have a basic understanding of how they work. Again, very frequently used, very readily available, and again, quite a few benefits in using forward exchange contracts to protect against market movements. So very simply, what a forward exchange contract does allow is for a business or private client to secure an exchange rate today for a defined amount of currency today, but they can assign a future settlement date. So some of you might recall that example where I put forward the example of an importer, which has a $50,000 US level of exposure today. They don't need to make an end supply payment until day 90. In that example, the importer may well have the ability, well, they do have the ability, frankly, to establish a defined and certain exchange rate, either for a portion or for the full amount of that exposure on day one. They've got the benefit of securing exchange rate today, and again, they don't need to deliver the Australian dollars to OFX until day 90. They have eliminated the level of uncertainty or level of volatility for the full course of that contract on day one. And equally, you can look to start layering forwards or use multiple forwards, honestly, for the full, which add up or aggregate to the full amount of known exposure. So again, in that example, you are hedging actively, or in fact, hedging entirely on day one for a defined period and a defined amount of currency. So again, one of our motivations today, I suppose, is to break down some of the misconceptions around forward exchange contracts, and equally break down some of the more broader misconceptions around the active use of currency risk management tools. Because the reality is a lot of these things are available both in digital platforms, which again OFX can provide, and equally there is an abundance of available support in terms of how these products can be best used. We'll always typically recommend customers to be very conservative and very well considered when they're using these products for the first time, just to ensure that they are used relatively conservative and again in the right context, not only of underlying requirements, but in the right context of some of the things we are observing in the markets of today as well. Look, so conscious that, again, we've covered a fair bit of ground. If there are questions in the later part around, again, how businesses or, again, private clients can look to craft a currency plan, we'd love to hear from you. Look, just finally, before I do pass on to Jonathan, just some, I suppose, basic or, again, very simple tips, if you like, that, again, hoping some people can just take away from today. I've used this example on a couple of occasions already, but again, really want to call out that time is your friend. Don't be rushed into making a currency choice when you have the benefit of an extended period. You can use the full course of time to, again, to layer, to smooth, to eliminate, and to reduce the underlying sensitivities which the market will often surface or the market will too often create. So again, don't often be feared or rushed into making a currency choice. What we'll also typically recommend is try to be, where possible, very rational and very measured when making currency choices. Again, I've already touched on it again, but today too often we see a lot of participation or a lot of currency choices being made out of fear or based on emotional-based decisions. You want to be considered and you want to be, I suppose, really well informed when you do step up to the table to make currency choices. Be situationally aware, and again, the markets of the day do matter. The markets of today, frankly, are vastly different to those that we're observing over the last 6 months. And that really is a case in point for a lot of businesses in particular who are navigating volatile markets for the first time. If you're an organisation that's only been in business for 6 months or 1 year, or in fact 2 years, the dynamics of today are vastly different to the dynamics of yesteryear. And again, if you're operating through these types of, I suppose, markets for the first time, it adds a little bit of risk, adds a little bit of complexity. And again, it can make it more difficult to make rational and measured decisions. So again, you want to be conscious of that and just make sure you aren't necessarily tripped up by lack of understanding around what's happening today. Look, just finally, I've touched on it already, but really call out risk management. It's not a perfect science. It does involve a little bit of investment of time. It does, I suppose, involve a little bit of active review. You need to be quite methodical and at times quite disciplined against your currency plan to ensure you're maximising your currency outcomes over the longer term. So it's not a perfect science. There is a little bit of testing and learning. But again, guys like OFX, we're here to help you through those types of conversations. And again, we can obviously help calculate what certain payoffs do or didn't look like as well. So again, mindful we've covered some time. I'm going to pass briefly now over to, again, my colleague, Jonathan Sermon, who, again, he's been in our business for a very long time. What he's going to do is he's going to explain our partnership model in a broad sense, as well as hopefully hearing from some of our customers and partners as well in terms of how they do, again, benefit from the likes of OFX.
Yeah, thanks, Michael. Much appreciated. Conscious of everybody's time as well, but I guess for me, appreciating that a few of you in the audience were quite keen to learn a little bit more about how the referral program works, because you do have a few clients that maybe fall into that risk side or do, as part of their day-to-day need, to make money transfers. So I'm just going to let you breathe in, I guess, some of the comments from one of our referral partners who does play in your space and very kindly supports us. But as Don mentions there, we are here very much to support you and your business and your clients. Whether you are a 1 or 2 head firm, a mid-tier, we even partner with some of the people up in the big 4 as well. But 2020 has certainly been the year of the accountant. One can only imagine, with all the government announcements that came over the last few months, not only did it come with a barrage of questions and emails from your clients, it probably came with a barrage of questions from some of the staff as well. You guys have certainly been on the front line with your clients, with your teams, and I'm sure that there's probably many of you have done this free of charge for them as well. So going back to some of Michael's thoughts on the hedging side of things, some of the things that we've spoken and seen a lot with our companies and our referral partners is wanting to opt in to really mitigate risk and get a sense of where they're playing in the next 12 months. This very much came along after the government stimulus packages. So when JobKeeper, JobSeeker, and I guess even the asset write-off came in, a lot of our business clients were quite keen to lock in their exchange rates, giving them peace of mind because they had a sense of the income coming in from their government stimulation packages. Again, 35% movement over 6 months. What does that mean for your clients and their bottom line? We've also seen a real interest from our corporate clients around having a specialist to lean on, having someone to be able to pick up the phone to get a sense for what's going on, not only in the accounting world, but in our space as well. And I guess, as Michael alluded to, the fact we have 24/7 support for our clients certainly gave them a lot of peace of mind. So in my time, I have been in the industry for a long time, and I guess when you look into the accountant space, we've helped clients pay for staff over some of the larger entities that we look after. And see what does that look like over the 12-month time in terms of knowing what it's going to cost them in Aussie dollars. We've all probably done a little bit of online shopping over the last few months, online retailers and front of stores as well. They've been huge supporters of our businesses, not only because they could be entering offshore markets, so they're receiving funds incoming from their sales, but actually looking to get their samples and make payments overseas as well. And I guess touching on that Aussie US graph that you saw, we did see that plummet down to 55 cents. So that meant a lot of our private clients were taking advantage and actually selling any US shares. So really enjoying the benefits of growth within the firm they work for in some of the tech industries and taking advantage of the plummet down to 55 too. So what we typically offer our referral partners is very much just an OFX expert to very much be like almost a concierge to your business. We appreciate this isn't front and center day to day for you guys, but many of you have indicated that you do have some clients that this does impact, and obviously it does impact your business as well. So it is very much a kind of spot and refer model that we do have with our accounting partners and bookkeepers and VCFOs. There's obviously no cost to implement, but it's very much a kind of value add to any SME, family office clients, high net worth or cross-border clients as well. Typically how we add value is by saving them not only time but money as well on the rates, but also the transfer fees. So what I tend to see and what I tend to field is very much complaints around the TT fee when a payment is being made, but also maybe a fee when it's been received from a supplier as well. So we lose the transfer fees on both sides of the transaction. So very much a tangible saving. And then over time, because our margins tend to be tighter than the banks, then there's actually an addition to the profit line as well, which should be a good result for your clients and hopefully justify some fees along the line too. Because all we do is FX, we're not going to I guess conflict with any other service providers too. So a lot of the mid-tier firms, they enjoy working with us because all we do is focus on their foreign payments for their clients or their staff and even their consumers as well, whilst they can still have other relationships intact for other service offerings. We also plug into Xero. I'm sure many of you online have heard of Xero, the accounting software. We plug into that, which in essence feeds back all the data, the rates that they get, the settlement times into their Xero platform. So it typically works very, very well for our bookkeepers and the community that we support there. We spoke about the online retailers. We're seeing a lot of Aussie businesses that are looking to expand offshore and expand overseas, and they're really enjoying our global currency account, which enables them to receive funds in various currencies, make payments in those currencies, and then repatriate any profits back to headquarters as and when they wish as well. So typically where my team and I fit in is we're very much just a point of contact with the accounting community, with the bookkeeping community, where they can introduce a client to us personally, perhaps sense check us for any benchmarking to make sure that we can add value before they have a conversation or review with their clients, or even set a client up themselves. Many VCFOs we work for like to add value fairly quickly when they've been appointed because they've either used us in a big firm that they've worked for, or actually they just like to use us and justify their employment pretty quickly as well. We're also very open to setting up referral partners. We've done a few team talks, lunch and learns with some of the firms we work with, and no doubt our marketing team are always happy to add any content, so any newsletters or education to any of the younger staff. That's really where we like to play as well. So there's my details on the screen. Please feel free to reach out, connect with me on LinkedIn, drop me an email. Always happy to have a conversation. In the 18 years in the industry, there's probably not much I haven't heard. And if I haven't heard it, then I'll be reaching out to Michael as well to assist. But thank you very much for your time.
Thank you, Jonathan. Look, very, very conscious we're close to the 2 p.m. mark, but nevertheless, great to see a couple of questions come through. So what I'll do, I'll read those back, and then obviously we'll pull apart a couple of answers for the audience before we wrap up. So a quick question from the audience. Will the treatment or the processes be the same for personal usage versus business usage? Look, great question. Both businesses and private clients, again, you are able to register through our website, OFX.com. It's a relatively straightforward process. Obviously, for a personal client, we are very proud to offer straight-through processing on more than 80% of all of our registrations at time of registration. So it is a relatively straightforward process, but nevertheless, the same can be said as well for any business who is looking to register. Okay, so one question specifically around FX risk management. A question is, if your business was highly exposed to FX, why would that business actively choose to manage 80% versus an example, say, of 100%? Look, it's a good question. I think in that circumstance, a business would make an active decision to hedge, say, 80% versus 100%. Potentially, if there was a perception that the market was actually going to be in their favour. The other key determination around hedging is that a lot of business will often choose to hedge a portion versus the full extent of their exposure, simply out of recognition that things can change in business environments, which is to say we can all set the course and make certain assumptions around what your requirement will look like. But again, through supply chains, and particularly through global supply chains, things throughout short periods of time can change. So again, businesses are recognising that. And as a result, you may well see hedging ratios of 80% versus, say, 100% in that type of circumstance. Again, another product-specific question here in terms of whether we do assist customers with caps and collars as a specific currency management tool. Now, we do offer vanilla options, which does allow businesses to set a target rate, and at expiry, by example, if the market rate is above that target rate, again, they can participate in that type of favourable movement. So specifically around caps and collars, no, it isn't a currency management tool that we do offer, but there are types of currency options which are available, particularly for Australian-based businesses. Okay, so I think we've got time for one final question. Again, it's an interesting one. The question is, I normally have a short time frame to transfer money, as in weeks. Are there strategies that can be put in place in such circumstances? Again, look, the answer simply is yes. You know, we have seen many circumstances where people have currency requirements in, you know, call it 5 to 10 business days. And again, there are lots of products and lots of strategies which can be put in place to maximise your currency, I suppose, outcomes in very short periods of time. So again, you can look at things like options, you can look at things like forward exchange contracts, and equally mix that in with spot transactions as well. Look, so we're going to conclude, but I want to thank everybody for joining us today. Post today's webinar. The survey, which should hopefully appear on everybody's screen shortly. Again, thank you very much, and we do hope to hear from you at some point in the future.